Happy March Madness. Hope everyone's having a good week so far and enjoying the game so far. Wanted to shoot a quick video today on the topic of tax strategy. So I wanted to give you two simple, pretty effortless strategies that you can implement in your portfolio to put some money back in your pocket at the end of the year from a tax perspective. So what are those strategies? The first one is utilizing tax efficient investments. And the second one is what we call tax loss harvesting. So what are tax efficient investments? Believe it or not, there's about $16+ trillion invested in the markets right now in investments that are not tax efficient. And those are actively managed mutual funds. An actively managed mutual fund, for someone that doesn't know, is a bucket or a basket of stocks that's managed by a fund manager who can buy and sell those stocks for a number of different reasons. For example, reallocating the strategy or rebalancing the fund allocation itself. It could be investors buying in or liquidating out of a particular fund. Anytime a fund manager makes a change, internally that's a taxable event and potentially a taxable gain distribution to you as a shareholder. The CFA actually did a study, and the tax drag that this has on actively managed funds is about 1 to 1.2%. So think about that. If you've got $100,000 invested in an actively managed mutual fund, you're paying about $1,000 to $1,200 a year in additional tax just from the capital gains distribution. So how can we change that? How can we reinvent the wheel? Something that you can consider is a tax efficient investment. An example of that would be an exchange traded fund, an ETF, or an actively managed tax efficient mutual fund. So they're out there. An exchange traded fund, what it does is it actually tracks a particular sector of the market or an index in the market. So there's not a lot of turnover within the actual fund itself. And when there's not a lot of turnover internally, that's not triggering these taxable events throughout the year. And again, passing distribution gains on to you as a shareholder. The only tax in an ETF or an exchange traded fund is when you actually sell it. When you sell that ETF for a gain or a loss, that's the taxable event. The internal turnover, which is very, very minimal in an ETF, is virtually eliminated because there's not a lot of change like an actively managed mutual fund. The other thing I talked about is tax loss harvesting. So an example of that would be, let's use ETFs again. If we have an ETF that tracks the S&P 500, let's use the symbol SPY, for example. If we've got $100,000 invested in SPY, the market takes a turn and it's down, let's say 10%. So if you've got $100,000, it's down 10%. Your investment in SPY is now $90,000. You can actually sell that, capture the loss. So sell the $90,000 worth of SPY, capture that loss, immediately reinvest back into something with similar market exposure, stay invested, and then down the road, you can use those losses that you harvest to offset the gains in the future from a tax perspective. So it's strategies like that. It's ETFs and tax efficient investments that we utilize for clients each day that you can take away and implement potentially in your portfolio. So hopefully you guys find that helpful. Have a great rest of the week. Good weekend. Enjoy the games. And we'll talk with you soon. Take care.